All right, let's start with one of the most important concepts in this section, and that is the holding period. The tax treatment of a capital asset really depends on how long the taxpayer held it before selling it. As a general rule, if the asset is held for more than 1 year, it qualifies for preferential tax treatment, meaning those lower long-term capital gain rates will apply, and we'll talk about that next. If it's held for 1 year or less, then it's short term and it's taxed just like ordinary income. So no special benefit here. Now there are a couple of important exceptions to be aware of. First, if property is received as a gift or through a non-taxable exchange, the taxpayer typically inherits the holding period from the person who transferred it. So you don't start over at zero, you step up into their timeline. Second, if property is acquired through an inheritance, the rule is even more favorable. It is always treated as long-term, regardless of how long the original owner held it or how long the heir holds it before selling. So big picture here. Before we even think about tax rates, the first question is that we should always ask is, how long was the asset held? So now that we've looked at holding period, let's talk about how capital gains are actually taxed. For most capital assets, long-term capital gains are taxed at preferential rates, and those are 0%, 15%, or 20%. Which rate applies depends on the taxpayer's taxable income, not just the type of asset. So lower income taxpayers may pay 0% on their gains, while higher income taxpayers may fall into the 15 or 20% range. But regardless, these are lower than our ordinary income rates. Now, not everything fits neatly into those three rates. There are a few important exceptions. For example, when we're dealing with depreciable real property, like buildings used in a business, part of the gain can be taxed at a special 25% rate. That's related to depreciation, and we'll talk about when we cover recapture. Also, certain types of assets like collectibles or qualified small business stock, sometimes called Section 1202 stock, can be taxed at a 28% rate. So right away you can see that not all capital assets are treated the same. Now, one quick update from recent law change under the OBBB, or the One Big Beautiful Bill Act of 2025. There were some updates to the qualified small business stock rates. The gross asset threshold increased from 50 million to 75 million, and there's now a tiered exclusion based on how long the stock is held. So 3 years holding period gets you a 50% exclusion, 4 years gets you a 75% exclusion, and 5 years gets you a full 100% exclusion under this change to the tax law. Now, we won't go deep into that calculation here, but you should understand that holding period and asset type both drive the tax result. So again, step one is your holding period, and step two is what type of asset are we dealing with? All right, now let's talk about something that students often find confusing at first, and that is the netting process. So when a taxpayer has multiple capital transactions during the year, we don't just look at each one separately. Instead, we group and net them together. So first, we take all of the short-term gains and losses, meaning our assets held for 1 year or less, and we net those together to get a single short-term result. Then we do the same thing for our long-term gain and losses, and those are our assets held more than 1 year, and we net those to get a single long-term result. So at that point, we've simplified everything down to just two numbers, one short-term result and one long-term result. From there, those two amounts are netted against each other. Now here's why this matters. The final result determines whether the taxpayer has an overall gain or loss, how much of a loss is deductible, and what tax rate applies to any gain. So this process is really important because it drives the final tax treatment. So the big picture here is, even if there are 10 different stock sales, we don't tax them individually. We always boil it down through this netting process first. All right, so now we're shifting from capital assets to business property, and this is where things start to come together. So first, remember that Section 1231 assets are, they're used in a trade or business, and they are held for more than 1 year. So think things like buildings, equipment, and other long-term business use assets. Now, the key feature of Section 1231 is that it gives us the best of both worlds, but we have to get through the process first. Just like with capital assets, we net all gains and losses from Section 1231 property together. After netting, we end up with a net gain. If we end up with a net gain, it's treated like a long-term capital gain, which means preferential tax rates. If we end up with a net loss, it's treated as an ordinary loss, which is fully deductible. So that's a big advantage. But, and this is important, before we get that favorable capital gain treatment, we have to deal with something called recapture. Recapture rules apply when the taxpayer has taken depreciation deductions on the asset in prior years. So the IRS basically says, you've already received a tax benefit from depreciation, so part of your gain shouldn't get preferential treatment. So what happens is a portion of your gain up to the amount of prior depreciation is going to be reclassified as ordinary income. And the remaining gain beyond that can still receive capital treatment. So it's really confusing here, but when you think of Section 1231, think first I want to net it, so net it first, then apply my recapture rules, then determine what is capital versus ordinary. All right, let's build on what we just talked about and tighten this up. After we net all of the Section 1231 gains and losses, we end up with one overall result. If that result is a net gain, that's the ideal outcome because it gets preferential long-term capital gain treatment. But if it's a net loss, then it's treated as an ordinary loss, which is fully deductible. So again, best of both worlds depending on the outcome. Now I want to pause for a second and connect this back to something you already know. You might be thinking, wait, aren't capital losses limited to $3,000? And that's true for capital assets. That $3,000 limitation does not apply to Section 1231 losses because these are ordinary losses, so they can fully offset other income. Now let's bring back the idea of recapture because this is where things get way more technical. Section 1245 applies primarily to personal property, things like equipment and machinery. If that asset has been depreciated, then when it's sold, the portion of the gain equal to prior depreciation is recaptured and taxed at ordinary income rates, which we talked about in the last slide. So even though we might have a gain overall, part of it gets pulled back into ordinary rates. Then, and this is key, any remaining gain above that depreciation is taken, above the depreciation that was taken, is taxed at those preferential capital gain rates. So the way to think about this is first net the 1231 gains and losses, second, apply the recapture rules, and third, whatever is left may qualify for capital gain treatment. So just hitting on that same concept again. Okay, so this slide ties together two areas that don't always seem connected at first: business property sales and the qualified business income or QBI deduction. So let's break it down. Under the final regulations, when we calculate QBI, we generally exclude capital gains and losses, whether they're short-term or long-term. So in most cases, those gains we just talked about, they do not factor into QBI. But here's an important exception. If part of the gain is not treated as capital, specifically if it's ordinary income due to recapture that we talked about on the last slide, then it doesn't get included in QBI. And that's where Section 1245 comes in. Remember, Section 1245 applies mostly to that depreciable personal property like equipment that we talked about in the last slide. When that property is sold at a gain, the portion of the gain equal to prior depreciation is recaptured as ordinary income. Because that portion is ordinary, not capital, it is included in the QBI calculation. Any gain beyond that, meaning the part that is treated as a capital gain, is not included in QBI, or qualified business income. So, taking a step back, a good way to think about this is, first is the recapture portion is included in QBI. The remaining capital gain is excluded from QBI. And just to connect this to the bigger picture, that recapture exists because the taxpayer, again, they already received a benefit from depreciation deduction in prior years. Now, one last reminder from earlier chapters, the QBI deduction is currently 20%, and that provision has been made permanent under recent law changes. All right, now let's compare this to Section 1250 property, which is a little different from what we just saw with Section 1245. Section 1250 applies to real property. So think of buildings, whether they're residential or commercial. So instead of equipment, now we're talking about things like rental properties or office buildings. Just like before, depreciation plays a role, but the recapture rules work differently here. Instead of treating all depreciation as ordinary income, like we do with Section 1245 property, Section 1250 uses something called unrecaptured Section 1250 gain. Here's what that means. The portion of the gain that is due to prior depreciation is not taxed at ordinary rates, but it also doesn't get the lowest capital gain rates either. Instead, it's taxed at a special maximum rate of 25%. So it kind of sits in the middle. Not ordinary income, not the lowest capital gain rate, but capped at 25%. Then just like before, any remaining gain, meaning anything above the depreciation that was taken in prior years, is taxed at regular preferential capital gain rates like 0%, 15%, or 20%. So the way to think about this is the depreciation portion is taxed up to 25%. The remaining gain is taxed at standard capital gain rates. Now this brings us to the end of this video, and I want to just take a moment and acknowledge the fact that I know that we covered some really heavy content here. I really want to hear from you all, and if you want me to walk through some examples of how this all looks in practice, I am more than happy to do that, but I really need to hear from you all first if you want me to do that. If you do, shoot me an email, respond to this video, comment in any of the posts that we have in Moodle. Just let me know. I don't want to take the time to put examples together if you understand it already, but if you don't, I certainly want to spend the time to do it. All right, I'll see you in the next video. Thanks.